right, let's get it going. Okay, welcome everybody. Thank you so much for joining us. This is a webinar titled Passive Real Estate Investing Through Private Placement Funds. I'm Sean McKay with American IRA, and today we're very lucky to have with us Bill Fairman of Carolina Capital. Bill, thank you so much for joining us.
My pleasure. Thanks for asking.
Absolutely. So I've known Bill for a number of years, probably at least 6 or 7 years. And as is typically the case with our joint webinars, I tend to bring on individuals that are incredibly knowledgeable on their topic, on their business. And many times people such as Bill that I've learned a great deal from myself over the years. So this will be content heavy today. So I appreciate you all for joining us. Just a little bit of housekeeping notes. This is recorded, so certainly feel free to ask us about that. Moving forward, we will be sending out an email blast with the recording, assuming we get Bill's blessing post-event. The first 10 or 15 minutes, we'll just kind of run through some self-directed fundamental concepts, as we do have a lot of non-clients listening to this live. If you're a current client or just someone who's heard me speak many, many times, I do apologize, and we'll try and make it as painless and quick as possible. But again, we do want to make sure that we're able to introduce this concept to our non-clients listening. And so after my 10 or 15 minutes, we'll turn it over to Bill so he can educate us on the world of private placements. It's certainly an interesting world and one that we get a lot of questions about. To be clear, American IRA is not promoting Bill or Carolina Capital. As I said, terrific guy. I know his business partner and sister, Wendy Sweet, as well. They're very knowledgeable individuals, and so we certainly enjoy having them for educational content. But again, we are not promoting their fund specifically, as we are a passive third-party administrator for retirement accounts, so we are never promoting investments. But we do think Bill is a great guy to learn from on that space itself. So without further ado, we'll go ahead and get right into it. So if you're unfamiliar with the topic of self-directed IRAs and 401ks, today the real charge is for us to just simply introduce to you some additional options that are available with your IRAs and 401ks that you may not be familiar with. Certainly, most of us are aware that we can use our retirement accounts to invest in stocks, bonds, mutual funds, all of the typical products that we're used to when dealing with banking institutions and financial advisors. And those are certainly great options for you. Again, today, if nothing else, if you get out of this next 10, 15 minutes that you can invest these retirement accounts in a variety of opportunities outside of stocks, bonds, and mutual funds, that for us will be a win. As I said, we're never promoting specific opportunities to you. Our role is just to educate and make you aware of a wider variety of investment options that are available with your IRAs and 401ks. So when we talk about a self-directed retirement account, I want to make sure that we're clear on a few fundamental concepts. The first being, as the name indicates, this is a self-directed account, meaning that you as the account holder will be making the decisions for how your IRA or 401k will be invested. As I said, financial advisors are great resources for you, but we are not financial advisors at American IRA. You are identifying the investments that make sense for your portfolio. Certainly, many of our clients will lean on a team of people to help them. They may still be communicating with their advisors, with their CPAs, with their attorneys, and with investors that are experts on the specific investments that they're looking at investing in. If it's real estate, they may be leaning on appraisers and realtors and real estate investors and all sorts of people to help them make the decision. But keep in mind that American IRA is not promoting investments for you. The second concept is when we hear the term self-directed account, some people think, well, I can choose my own stocks or mutual funds or index funds, whatever the case may be. And I consider that a partially self-directed account. You're certainly making the investment decisions, but if you're with many of the financial services firms that are out there, you're relegated to a small group of products that you can invest in. Again, stocks, bonds, and mutual funds. Now, if you have a truly self-directed account, you can go beyond just those types of investments. Our clients are, as I mentioned, investing directly into real estate projects. Sometimes they are lenders for other investors or business owners, and they are just simply the bank for those individuals or companies. And as I mentioned, today is going to be focusing on the idea of private placements. So Bill's going to speak to what that looks like, and other investments such as physical gold and silver, known as precious metals, can also be acquired by your retirement accounts. Now, at American IRA, as I mentioned, we are technically the third-party administrator for your retirement account. So we're the financial services company that is doing the record keeping for your retirement account. Now, we are a fully integrated company, meaning that New Vision Trust Company, which is our custodian, is also the same principal as our administration company. So American IRA and New Vision Trust Company, the principal for both of those firms is Jim Hitt, who is our CEO and founder. He founded American IRA back in 2004 in Asheville, North Carolina. Since then, we've grown. We have branches in Charlotte, North Carolina, where I'm located most days, as well as Atlanta, Georgia, which is our newest branch. So we're very lucky to be expanding. We are actually moving towards almost 500 million in assets under administration. So we're very excited about that milestone when you think about that $500 million in assets. So we've certainly grown considerably over the last few years, and we're very fortunate for that. And in terms of our model at American IRA, I could certainly spend a lot of time discussing the differentials between us and other firms. I will just simply say our fee structure is very unique. You are not paying a higher annual fee as your account balance grows, as is typically the case with most firms. And we do free cash accounts. So many times clients will open and maybe even partially or fully fund their account before they have an opportunity that they're looking to invest in. And so with most firms, they start charging you the annual fee immediately or based on a certain time of the year. At American IRA, your funds can sit dormant for months or even years, and we're not charging you that annual fee on the IRAs because we feel as though it's more important for you to get set up and ready to take advantage of the opportunity. So we want you to get that account set up as early as possible. And also the fact that we are frankly experts in the asset classes that our clients are investing in. We don't talk just theoretically about what can be done from our principal to other firm members such as myself. We're heavily involved in different investment strategies. And as I said, I've learned a great deal from people like Bill. So this is a real passion for us at American IRA. Now, the key with these self-directed accounts is to understand that your retirement account typically will not change forms. So if you currently have a traditional IRA with fill-in-the-blank firm, Wells Fargo, Bank of America, you would also have a traditional IRA with us at American IRA. We use the term self-directed as really kind of a marketing concept in our industry. The retirement account itself is not changing forms whatsoever. Also keep in mind that this is not an all or nothing proposition. You may decide to just simply move a portion of your Roth or your SEP or your Simple over to us so that you can make an investment in a real estate deal, for example. So you don't need to move your entire balance over to American IRA, just what's necessary to the investment and our cash balance requirements of $750, etc. So the accounts themselves are not typically changing forms. Now, as I mentioned earlier, real estate is certainly the general asset class of real estate is what Bill will be educating us on today. So when you look at real estate, any type of real estate can be owned by your IRA or 401k. So anything from raw land to condos, townhouses, single family houses, commercial buildings, apartment complexes, industrial buildings, all of those assets can be owned directly by your retirement account. Now, also, as I mentioned, there's the ability for your retirement account to be the bank and to be the lender and lend other investors money. Depending upon the state, that'll either be a deed of trust or a mortgage. That's that security instrument, if you will. It can also be secured by business equipment, for example. That's something that we see a bit of. And so that's a UCC1. So again, that's just a different form of a mortgage, if you will. And LLCs is something that will kind of tie in with a lot of what Bill is speaking about today, where a retirement account can become a member of an LLC that will go on to make investments, whether that's being a lender, whether that's owning assets directly, such as a piece of real estate. There's a lot of different flavors to that. So there's a lot of opportunities, and really the way the IRS code is written is it tells us what we cannot invest in, which is essentially collectibles and life insurance policies. That's really kind of the scope of what we cannot do with these self-directed accounts. Now, as we dig in a little bit deeper with real estate, keep in mind that as long as it's an investment strategy, typically you can do that investment inside of your IRA or 401k. So whether that's purchasing rental properties, doing a fix and flip, just like you see on TV, doing wholesale or option deals where basically you're controlling a property without actually owning it. You're controlling the contracts, if you will. And joint ventures, which is just another way of saying a partnering deal where your IRA owns a portion of a loan or of a property or of a business, etc. And again, private lending is just simply being the bank or being sometimes called a hard money lender for other investors. Now, to me, I'm always a bit of a visual guy. So as we look at this chart, hopefully this kind of gives you a different way of articulating what this process looks like. So when you start in the top left, you see that the IRA is many times going to be paying cash for assets, and that cash would go directly to the acquisition of, in this situation, the house. And then as the house is either throwing off income from being a rental property or from being fixed up and then sold to another third party, the cash, the profit, if you will, from that house will directly flow back to the retirement account because, again, the retirement account is the owner of this asset. So again, I'm going to just turn it over here once again. Bill Fairman with Carolina Capital. He's going to talk to us about private placements. And bear with me, Bill. I'm going to just turn the keyboard and the mouse over to you here.
Okay, excellent. Sean was very kind, and he does know a lot of very knowledgeable real estate investors. Apparently none of those were available, so he asked me to come on. One of the things we were just talking about while I have you on here, Sean, 400 million under management. That's really good. How much do you think is under management right now that is not invested in any investments, that are just sitting there in cash?
Yeah, that's a great question. Just generally percentage wise, we find that I don't know what the reason is for that, but our clients tend to be more invested into assets compared to the cash that they're holding. As just kind of a general note, as you're looking at our industry. So most of the times with most firms, a larger percentage is being held in cash. So we're kind of on the lower end of the spectrum, and I think that's because our clients are really kind of prolific investors. So percentage-wise, I would say certainly a good bit less than 50% is in cash on the high side at any point.
And the reason I bring that up is because, you know, you go to all the trouble of putting some money into a self-directed account, and then the hard part is finding a deal to put your money in. And then at the same time, when you do find a deal and then that deal is over, let's say you own a property and you sell it and you have profit and you put that money in, now you have to go out and look for another deal. If you're a private lender and you lend money to someone, eventually that loan is going to pay off. And then now it's sitting there waiting for the next deal. And that's the beauty of private placements. Once you're in a private placement fund, your money is always invested. And we'll get to that in just a moment. So, yeah, I don't have control yet, it doesn't look like.
All right, let me try that again.
However,
okay. Sorry,
I am going to, yeah, I'm still getting, let me try this. Nope.
I think there's sometimes a little bit of a delay. So did you move the mouse?
Yes, I did.
Okay. And you clicked on it just to make it live?
Yep.
All right, I gave the ownership to you, but I can certainly take it back if you want me to manually drive it for you. Okay, there you go.
There we go. Okay. Sometimes we have to learn how to drive new cars, new vehicles. Okay, so I'm going to get to the boring part. We are talking about SEC-controlled private placement funds. So I have my nice little disclosure up here. I'll wait while you guys read. Just kidding. I will break this down and summarize. Basically, this is education purposes only. Okay. Sean asked me to go over different funds. We are not promoting any fund. We are not selling any particular security. Each fund that you have an interest in investing in has a private placement, has a prospectus or a private placement memorandum. You need to read those, just like you hear on the really fast talking guys on the commercials. Read your prospectus in order to invest wisely. Anytime you invest in any type of investment, there is risk associated with it, and your mileage may vary. So this is usually me at work. What is it that we're all looking for, right? We're looking for a pot of money or a bag of money and a stack of gold coins. We're looking for certainty that we can achieve a certain investment level for our retirement. And at the same time, we want to have safety knowing that we're going to be able to keep that investment or at least not outlive our retirement. And that's funny. We typically are taught that I have to get to a certain retirement number and I have to do my best to die before I run out of that. Well, when you're investing passively in real estate, really your goal is to keep your principal after you've finished your growth part of it. Is that you allow that balance to continue to stay where it is and not dipping into it, and then having something that you can pass along to your kids or to your grandkids at some point, right? So with safety comes low returns. As you guys know, you're not getting value for saving. Savings is not earning anything. And I looked long and hard to find a CD that paid this kind of return. But if you look at the fine print on this one, it's a minimum of $50,000 deposit. So you can tie up 50 grand for 2 years and make a whopping 1.5%, or for 1 year, 1.3%. Now, I did this treasury yield on the 13th, and I looked at it this morning. I think we're in the 2.3% range. So here again, you're tying your money up for 10 years in order to achieve a 2.3% return. Wow, that's great returns. Now, I'm sorry, I know this looks kind of scary. Wall Street, I'm not saying Wall Street's going to go down. You make money in Wall Street. It's a long-term investment. It's just that most of us feel like we have not only no control, but we don't understand the forces that make things work, and that it's typically the big professional traders are the only ones that really make any money. I can tell you that, and this is anecdotal only, my own 401k that was invested in Wall Street, I never really achieved any more than what I put in and what my company that I worked for at the time also gave. So the percentage that they put in, I never, over 20 years, I never really made any more money than what was actually put in with the ups and downs of Wall Street. So this is why we love real estate. With real estate, obviously, you have a solid asset that's backing up any investment that you have. It's tangible. It's something you can touch. It's something that people always need. And oh, by the way, most every one of us here live in a house or a condo or have had a mortgage. We understand that. So why am I passionate about passive returns? This was me in 2011. After 25 years in the mortgage industry, and again, I was not an investor, I was a worker bee in the mortgage business. After the 2008 crash, I found myself out of work, and it was very difficult to make ends meet, and I ended up driving a long haul truck for a couple of years. Now, I was telling you about my 401k. Well, the last thing I wanted to do was dip into it. I didn't want to have to pay the taxes and the penalties on it. And, you know, it's the last thing you want to touch, even when things are tough. It was the worst mistake I ever made, because by the time I did have to get into it, it was only worth half as much. As you know, the market went down. And I was one of those perfect investors. I bought high and sold low. So let's talk about your typical private placement funds. Private mortgage lending is what we do. We're typically just the bank, okay? You have funds that hold properties only. And then you have funds that are opportunity funds, which are hybrid funds, and they lend, they buy notes, they buy tax certificates, they buy properties, they do whatever the market will allow. Now, let me tell you what a private placement is right off the bat before I forget. A private placement is where you or your IRA is buying a piece of an LLC. These private placement funds are investor-owned LLCs, and the manager is typically a separate management company that the fund essentially is hiring to manage the fund. Because if you have in a fund, you have 100, 150 investors in there, you have to have somebody to make the decision, because you can't have 150 people making the decisions. So a little bit of finance basics. If you're a lender, who would you like to lend money to? Someone who has no credit, no money, no prospects, or the person that has plenty of money, they're just smart enough to understand leverage, and they want to hang on to their funds because there's better exit strategies, more plan Bs. That's who we want to lend to when we're lending our money. Collateral basics. Now, you could lend, and one of the things that you can lend on in your IRA is a unsecured note. You have nothing to go back on. Well, if you're lending on a moped, something that will actually be worth zero at some point, and that you can stash in a garage if you have to foreclose on it or repossess it, and not be able to find it, that's not a good collateral. So what we like is the single family home. We like to see it in a subdivision with 2.5 kids in the yard. That is your best real estate collateral that you can find. There's two things that people always need no matter what the economy is: food and a roof over your head. So lowest risk to highest, your owner occupied single family, which I just discussed. Your highest risk as a lender or a property owner is the single purpose commercial or raw land. Why is that? Well, it's your piece of the buying pie is so much smaller with those focused properties, the single purpose commercial. Here's an example of two single purpose commercial facilities. One is a restaurant, one is a hotel. They're always going to be restaurants. They're always going to be hotels. The only people that you can sell these to are people that want a restaurant or want a hotel. The only way that you're going to change this is by massive redevelopment, and that costs a lot of money. So from a lender's perspective, if we made a loan on this and we had to take it back, we're always looking at how quickly can we sell the asset so we can get the money reinvested again. And the more focused the property type is, then the more you're going to have to discount it so you can sell it quickly and get that money back and get it reinvested and working. So the typical lending fund that you're going to find out there in the private placement world is going to lend on non-owner occupied single family. They're typically going to be a fix and flip or a ground up construction. They're going to have some sort of construction component. You don't need a private lender to just buy rental properties with, unless for some reason you have exceeded the number of loans you can get through conventional sources. And even then, those rates are going to be too high to be able to get any cash flow on your rentals. You're also going to see value add multi-tenanted commercial properties. Now, as I said, a single purpose facility is a higher risk, but a multi-tenanted is not as high. It's still going to take you longer to sell it because you still have fewer buyers when you're trying to sell it, but at least you're going to get rents while you're waiting to sell this property. And at the same time, it adds value the more tenants you have in there, the more that it's occupied. The other things that lending funds typically do are bridge loans. Now, a bridge loan is nothing more than, I need to buy this place right now. The market's tight. I've got 4 people bidding on this thing, and I need to act like I have cash. I can't wait on my bank to make this loan. And then typically those loans are going to be 30 to 90 days in duration, and you're just doing it because I need to acquire it right now. I don't have time to wait. The strategy for most lending funds is income and or growth, and this is primarily through interest payments and fees. Now, this is important to know. In an IRA, you can have some tax consequences when you're in a private placement, and you're again, I'm not a tax person. You'll have to consult your tax professional, but you could have some tax consequences in your IRA if you're investing in a business. With a lending fund, interest payments and fees, it's considered income through interest, and that is not going to be a taxable event for your IRA. So this is what you typically see on your fix and flip on HGTV. You've got this rundown house, and you turn it into this beautiful home, and it takes you 2 weeks, and everybody makes a lot of money, right? This is the sexy part of what happens in the fix and flip industry. Now, if you're doing this yourself, there really is a lot of work involved. But if you're lending on it, or you own a piece of a fund that's lending on it, you don't have the risk. You don't have near the risk that the owner of the property, the one that bought it and is fixing it up and selling it, has. This is an example of a value add. Now, this is the property that we actually did in Charlotte. It's 26 units. This is one of the buildings. And in this particular case, as you can tell, it needs help. And the borrower came in, bought the project at a really low price, and is fixing it up. And this is what it looks like now. If you're the first to rent that middle unit, you also get the bucket and mop to go in your home. So that's the bonus if you get in there first. So with this particular property, as the borrower, your strategy is several ways. One of them is, if you want to own it and get rents from it, then you're getting a loan through a private placement like ours. You're using the money to acquire the property. You're also borrowing the money to fix it up. You could, once it's stabilized, and what I mean by stabilized is that you're going to get tenants in here, and it needs to be rented in the approximate amount of whatever it is for the area. In other words, if the area supports 90% occupancy, then you need to be in the 90% occupancy range when you go to refinance it with a conventional lender through a bank. And then so you're going to refinance, you're going to pay our loan off, and now you're going to start collecting cash flow on this property. The other strategy would be that I'm fixing this thing up. I'm going to get it tenanted up to, say, the 90%, and then I'm going to sell it to an investor as a turnkey. So you're basically fixing and flipping an apartment complex and not a single family residence like most folks do. So this is fix and flip on a much larger scale. Now let's talk about property holding funds. A property holding fund will purchase multi-tenanted commercial properties. They can also invest in other funds that own properties as well, and they get returns from those funds as part of their income. And their strategy is to provide growth through appreciation and income from rental payments and or income from the other fund investments. Now, you have tax advantages from depreciation when you're in a property holding fund. If you're in an IRA, obviously your taxes are either deferred or exempt, depending on whether you have a Roth or a traditional IRA. However, again, this is all part of the fund strategy, and reading those private placement memorandums and or prospectus, it will tell you exactly how they are going to do things. Now, you can still utilize tax advantages from depreciation if your fund has leverage. So if this fund, for example, bought a property and then they borrowed some of the money to buy the property, that fund would have leverage. The IRS doesn't like it when your IRA has leverage, and they could also have a tax consequence with it. But don't be afraid of those tax consequences. It's really being charged against your profit, and these tax advantages from depreciation can offset some of the tax consequences that you have. Again, I'm not a tax professional. You need to consult your tax professional for that. I just want you to be aware that there can be some tax consequences with any fund. Just make sure you ask the right questions. So here's another same property. You're going to buy this property. You're going to hold it. You're going to buy it. You're going to fix it up. You can hold it and keep it within the fund and get income from it. At the same time, over time, you're going to get appreciation one of the strategies with a hold though is if you're using leverage to buy this, then you can, once you buy it and fix it up, you can sell it and the fund makes money. You can hold it and then the fund still makes money with the rental payments and then through depreciation. And then you get appreciation over time, which is not taxable, obviously, until you exercise the sale on it. Now, you can have a property holding fund that is specific to an individual property. Those funds, and now they wouldn't do this on this particular property because there's not enough units. You can have a fund, typically those types of funds are going to be 75, 100 units or more, where the fund is specific to one property. And again, there's different strategies with that. You can develop a new property, start from scratch. You can take B-type properties, C-type properties, and turn them into B plus. You'll never turn them into A. You're only going to turn them into A if they're new construction. So again, when they're finished, they're paying off. So the advantages to having your money in a private placement is that your money is always invested. So we were talking about this earlier with if you're lending money privately yourself and you're collecting payments monthly that is going into your IRA, what's going on with those payments that are coming in? It's typically they're going to sit there and accumulate until you have enough money to make a new investment. So in most funds, you're able to take that money and reinvest it and utilize compounding over time. The same thing that we talked about earlier is if you have a loan that's out and it pays off, then you're having to go out and find another deal. You don't have to do that when you're in a fund. It's always working. You don't have to worry about finding new deals. Diversification is a big deal. I always tell people you don't want to own a rental property. You want to own 10 because you're always going to have a stinker or two. And your job, if you own a bunch of properties, is to constantly look at your portfolio and find the ones that are underperforming, get rid of those, and buy some that will perform. But it never fails. Real estate is not an exact science. You're always going to find some that are going to be stinkers. A fund is pretty easy to diversify because you're in a property holding, the ones that aren't in a specific property, at least you have lots of doors to deal with. But a property holding fund where you're have multiple properties as well as invested in other funds that hold multiple properties, you're not only diversified through property types, but you're also geographically diversified as well. As most everyone knows that real estate is local, and while some markets are working great, others are not. I heard a interesting statistic yesterday on my way into work. They were discussing the vacancies of different cities, and the city with the highest vacancy rate, and a lot of you know that there's a big need for housing right now. There's a housing shortage in most communities. Well, Gary, Indiana has almost a 20% vacancy rate. So there's 20% of their homes are empty and no one's there because it's a depressed area. Now, the second highest was Hilton Head, South Carolina. That is not a depressed area, but they have a 17% vacancy rate. And even though it's a nice area, you still want to be diversified into as many areas as possible. The reason I feel that Hilton Head has issues is because there's a lot of second homes there. I would say 50% of the homes in Hilton Head are second homes. And when an economy is a little uneasy, or if it starts to turn south just a little bit, the first market to get soft is going to be your luxury market and your vacation home market. And I think that's part of the problem with Hilton Head. Passiveness. This is probably the best of all. You don't have to do anything when you're in a fund. You put your money in there, and the hardest work that you're going to do is doing your due diligence on the fund itself and the manager, making sure that that manager knows what the heck they're doing and that they're doing what the book says they're doing. But you don't have to do anything other than put your money into the fund and then collect your income quarterly or monthly, depending on the fund, or just collect your statements and watching it grow. The disadvantages are that you have to be an accredited investor in the vast majority of cases. Now, don't get me wrong, there are some funds out there that will allow a certain amount of non-accredited investors, but the vast majority of private placements require accredited investor. Now, an accredited investor, there's two ways to pass the test to become an accredited investor. You only have to pass one of them. The first one is income. If you're single, you have to make $200,000 a year, and you had to have made it for the last 2 years and expect to make it in the future. If you're married, it's $300,000. The other test is assets. Actually, it's net worth. You have to have $1 million in net worth, not counting your primary residence. Now, the advantage of not counting your primary residence is it's typically your largest debt. So when you're taking all your debts out and leaving what your assets are left, your net worth, that's good. The downside is that typically your primary residence is your largest asset. Funds have limited liquidity and they have lockup periods. And what I mean by that is, in our case, we make loans with our fund money. So if you needed your money back to go into some other deal, I can't say, hey, you need to pay your loan off because we have an investor that wants their money back. That doesn't happen. That money is tied up in working. Lockup periods are typically 2 to 3 years. Sometimes they're 7, depends on the strategy of the fund. Ours is 2. I know some property holding funds that are 7 years, and the strategy is to acquire a large, say, multifamily property at a decent price, get it stabilized, keep the income coming in for a while, and then sell it to another investor down the road. But they're typically 5 to 7 years you have to stay in these funds. They also have limited liquidity. They can't turn around and sell this property, excuse me, just because you need your funds back. So these are long-term investments. They're typically going to be, 3 to 5, 10 years out. So this is not something that where you would need that money back right away. These are long-term investments. Here's another thing. If you're a control freak, this is not for you. Because just like Wall Street, you have zero control when you're in one of these funds. You're depending on the management company to do their jobs correctly. This is why it's passive, because it's not active. And if you're an active investor and you have a hard time giving up control of an investment, then this is more than likely not for you. Now, the advantage to not having any control and being passive is that most people have full-time jobs and they don't have time to look and find, the right deals. And in our market right now, it's a little tight and it's harder and harder to find really good deals. 3 years ago, 4 years ago, there was a lot of low-hanging fruit. It doesn't mean that there's not good deals out here now, but it takes a professional to go out there and find them. So that's it for me. We're going to move it back to Sean. I know he's going to wrap it up, and I think we got some time for some questions after Sean's finished.
Perfect. Thanks a lot, Bill.
Sure.
So before I forget, everyone that's listening to this live, if you can type your questions into the questions box, that'll be helpful. Presumably they'll be for Bill and his business and private placements. So the questions tab, feel free to start typing those in. And again, as Bill said, just to wrap it up, so for those interested in, frankly, any strategy with their retirement accounts, please keep in mind that there is a process in order to have your account ready so that you could take advantage of private placements or just simply direct ownership of a rental or making a loan, whatever the case may be. So you want to make sure you first open and fund your retirement account. You're then going to identify the asset that you want to purchase. You'll be communicating with our team at our headquarters in Asheville, North Carolina. Many times it's via phone, fax, email, etc. And we'll assist you with the paperwork so that ultimately the end result is that your retirement account owns the asset, whatever that may be, the ownership interest in the private placement, or again, any of the other things that we highlighted today. So again, just to articulate this, some of you may just simply get the audio portion. This is Bill Fairman with Carolina Capital, and so his email is bill@carolinahardmoney.com. And again, I'm Sean McKay with American IRA, and my email is Sean, SEAN, @americanira.com. Our Asheville headquarters number is 828-257-4949. And Bill, if you're ready, yep, we've got a number of questions here.
Good.
Okay. When will the recording be available? So what we do is we extract the recording. Our marketing team works on getting it cleaned up. And I would say conservatively within maybe a week, we'll be sending an email blast for anyone who's registered. So certainly if you're listening to this live, we appreciate that. And you'll get a notice for the recording.
So if they're cleaning it up, does that mean they're going to make me sound more professional?
No, you're in good shape. They largely try to cut my rambling down from 10-15 minutes to about 30 seconds. So we'll make sure we get to Bill's content as quickly as possible. And MT, who's our marketing guru, the one that keeps me moving, she just said, yeah, we're looking at about a week. So hang tight for us on that. But thank you for that. And comments about the long-nosed truck.
Yes,
done it all.
A Peterbilt 379 or 389. I can't remember. It's been 2011, so it's been a while. But that was let's put it this way: it was a learning experience, one that I will never forget.
Well, I love that. Well, I don't love, but I respect the fact that you've gone through the ups and downs, Bill, and I've noticed that over the last few years, there's a lot of people that have done well, but you've maintained a humble mentality. So I appreciate that and I respect that. And we all know, there's a lot of things that go into success. So Bill's still the same guy as when I met him many years ago. So I love that about him.
Well, you didn't mention that I'm thinner than I was when I met you a while back.
Yes, Bill is the shrinking man. It's I think
it's purposely, by the way.
Yes, able to take a bit better care of himself. So Bill, if you could explain if these are non-recourse loans that the fund does.
Well, the beauty of investing in a fund is that it doesn't matter if our loans are non-recourse or not. based on what you could make a loan for, or if I was making a loan to an IRA. The only time it would be a non-recourse loan that we make is if I'm making it to someone else's IRA. So it depends. I'll give you the attorney version of that answer. It depends. Otherwise, yes, we have full recourse on all these borrowers. One of the things that we're always keeping in mind is that when you're a lender, you don't want to own property. If you're owning property, you made a mistake. And all the lender can, and we own a few properties. So by the way, just so you know, occasionally you're going to lose money in real estate. What you try to do, and this is why you need to diversify, is to make sure that you have a hedge against the ones that cause you to lose money or not make money. Okay. And when we underwrite, we're underwriting the borrower just like a bank. Now, our underwriting guidelines aren't as stringent as a bank would be, but we're doing the same things. We're looking for income, assets, character, credit. Hard money lenders, for the most part, are not just throwing money out to people. And then, but, you know, the vast majority of what we're underwriting is the underlying asset as well. So, long answer, yes, we do full recourse, and we will do non-recourse depending on the situation.
Okay, perfect. And just briefly to cover this for those of you unfamiliar with it, non-recourse is simply the borrower is not personally guaranteeing the debt, which is typically the case if you're going to buy a house for you and for your family to live in, etc. So, all right, Bill, thanks for going through that. What about extremely short-term loans such as transactional funding? Do you do those sorts of loans, Bill?
Well, we used to. We stopped doing that. It leaves yourself open for too much fraud doing short-term loans like that. So we just stopped the process altogether.
Yeah, like the theory of it, but yeah, there's, as you said, there's some ways to get burned. Which of these types does your private placement do? Just loans, or some of your deals are set up to collect rent?
Yeah, we are strictly a lending fund. We don't. The only property that we own are the properties that we've had to take back for one reason or another, and those are only going to be assets for a short period of time because we're going to sell them and get that money back and get it reinvested. So we're pretty boring. We're strictly a private bank, so to speak. So we only do lending.
Okay, perfect. Some of these are going to be, they're great questions, but a bit too technical into the taxes. And Bill did a great job of giving an overview, but we'll just have to be a bit careful.
Yeah, and again, I'm not a tax professional. I do understand that where some of the implications come in, but you're going to have to consult with your own professional for that.
Yeah. Okay. So a question was, so would your fund do deals in Hilton Head, and how would you take advantage of this?
Well, I hate to keep giving these attorney answers, but it depends. We typically do not like doing loans in resort areas that are heavy with second homes, rural areas. Again, as a lender, we're looking at, if I end up owning this property, and I'm always looking at worst case scenario. If we have to take this property back, how quickly can I move it? And just like we talked about in Hilton Head, there's 17% vacancies. That means homes are going to sit on the market a long time, and the only way to get rid of them is to discount them severely. So if we were to make a loan on a property in a resort area, it's going to be at such a low loan to value. Typically, the borrower needs more money than that. And what I mean by loan to value, let's say the house is, we may only lend 45 or 50% of the value on it. Mm-hmm. Whereas if it was a house in Charlotte, we would go up to 65 or 70%.
Perfect. So I'm going to tweak, there's a few questions in this realm. I'm going to tweak this to ask you, Bill, with lending private placements, can you give us kind of a general range of what you see for returns for investors in that general sphere?
Sure. Well, when we first started in this business, it was fairly easy to get a 10 to 12% return annualized. And now, as competition has brought in, and this really is kind of interesting for interest rates, the mortgage rates for individuals have been dropping over time. I'm sorry, they were going up a little bit because they were down, but now they're dropping a little bit. But hard money, private money, and bridge type loans have actually been coming down. Wall Street loves this space, and they have added a lot of competition. So I'm seeing the vast majority of these funds are going to be in the 7 to 9% return. It's important to understand, though, if you're in a fund for the long haul and you're looking for growth, you can actually get a higher return than the fund is getting if you're utilizing compounded returns. So if you allow that money, instead of taking the income from it, if you allow it to roll over and buy new shares, you can take a 9% return over 10 years and turn it into a 14% return just by compounding returns. But when it depends on where you are in your investing life. If it's time for you to start taking income, you want to build it up enough to where those returns are going to just pay you an income. And then, if you have time, just allow it to compound and you can get higher returns. Is that helpful?
Yep, absolutely.
Now, keep in mind that not all funds do that. Some of them will pay you monthly and there's no compounding. They just want to pay you an income and that's it. So it's, like I said, it's important to read the private placement memorandum and or prospectus.
Absolutely. So the next question is there a single versus married asset requirement for the accredited investor test? No, the $1 million is whether you're single or married.
Correct.
Let's see.
So, yeah, it's a family on the assets. The $1 million. It's the 200 for the income on a single person, 300 for a married couple.
Perfect. Thank you. How often do you make payments to investors, Bill?
Well, our fund pays quarterly. Everything is done on the quarters. But I have friends that have funds that pay monthly as well.
Perfect.
Okay. Oh, and just so you know, the vast majority of funds do not have any kind of a guaranteed return. You may hear something called a preferred return. Very few of the preferred returns are guaranteed. A preferred return typically, and I don't want to get too deep into the weeds, but I've already gone down that road. A preferred return is a benchmark to where other bonuses come in. Once you've reached the benchmark, there's some other bonuses that the fund manager typically receives over and above the preferred return.
Okay, great. So the next one is I just launched a brand to help corporate women leverage their 401ks by setting up IRAs to invest in real estate. I was given your company site from a friend. Are you open to referrals? Yes, love to. Correct me if I'm wrong. I assume you're speaking about the self-directed aspect. So at American IRA, yes, please reach out to us. We'd love to see if we can be of assistance in education and what have you. So thank you so much for attending. A suggestion for a webinar for account holders with Roths of less than 100,000 in terms of providing content for those account holders. So great suggestion. I appreciate that. And we'll definitely make a note.
By the way, I know some folks that are specialized in small balance Roth IRA investments. So I'll be happy to pass that information along to you, Sean.
Awesome. Thank you. Perfect. Let's see what else we. Um, Great. Yeah, just a lot of positive feedback. Thank you, Bill, again for your time. Any thoughts, anything you'd like to leave us with?
It's just very important that you do your due diligence on the front end, because once your money is invested, it's going to, in any fund, it's going to take you a while to get it back out. Now, everyone has there's a possibility of having an event that's catastrophic where, you need your money out right away, and each manager has discretion for that. But think of investing in a private placement at just like you'd be investing in a mutual fund over time. It's something that you're going to put money into and you're going to let it grow for a while. When it's time for you to start taking money out, then and move it, you get a little bit older, you don't need the growth, you need the income, then look at that strategy again. But it's very important to constantly look at all your portfolio and see where you need to tweak it to get your best returns.
Yep, absolutely. Well, again, everyone, especially who's listened to this live, I really appreciate your time and your questions. I realize for many of you, it's during lunchtime, you're in the middle of things. So thank you so much for that. Again, Bill Fairman with Carolina Capital, a lot of great information today. Thank you so much for sharing your expertise.
I appreciate it, Sean. Anytime.
Awesome. Well, thank you again. Thanks for the suggestions. We'll definitely be working to create some new content for everyone. And we hope to see you at a live event or a webinar soon. Thank you all so much. Have a great day.